Welcome to Accounting 201 Financial Accounting at Kapiolani Community College. In this video, we'll dive in depth into Chapter 11 that deals with organization of corporations, stock transactions, dividends, and retained earnings. The first thing to note about a corporation is that it's a separate legal entity from its owner. And part of the reason for its existence is that the owners are sheltered from any liability in excess of the amounts that they've invested in the company. Also, in a case of a publicly traded company that anybody can buy and sell their stock, it's easy to buy and sell shares of the stock so you can get in and out of the investment just about any time you'd want. This also makes it easier for the corporation to acquire funds in order to do expansion or whatever they may use those funds for. In addition, a corporation is not a human and not a person and does not have any finite life, so theoretically it can last forever. One more thing, professional management is typically present in large publicly traded corporations because there's a separation of the ownership and control of the corporation. The stockholders elect the corporation's board of directors, and the board of directors hire professional managers and officers to run the day-to-day operations of the business. So you tend to get a higher quality result in terms of management. There's also greater regulation, however, for corporations. So that's one drawback as far as a corporation is concerned, because compliance with these regulations is very costly. For large publicly traded corporations, they're governed by the policies and laws of the Securities and Exchange Commission. They have to produce periodic financial reports like the annual 10K report or the quarterly 8K report, and are subject to many rules and regulations that are there for the protection of investors. One more drawback from the corporation standpoint, there's possible double taxation of earnings. So $1 of income that comes into the corporation, if all distributed to stockholders, would result in corporate tax and tax to the individual stockholder who received the distribution from the corporation. So to journalize how this occurs, how the taxes are assessed on the corporation, that's our first adjusting entry that we would want to make for a corporation. Debiting income tax expense for the computed income tax cost for the company for the year, and crediting income tax payable for the amount that they owe, same amount. This becomes more complex in situations where there are differences between the company's books and their tax records. However, that's beyond the scope of this course. Another journal entry that's a very important one comes about because of the fact that corporations keep strictly segregated the stockholders' investment in the company and the company's growth through its earnings process. For example, at the end of the year, if the company has net income, they need to close that net income account that's sitting in income summary into their retained earnings account. And they do that through this journal entry here. So this is number 3 of the standard closing entries that occurs with a corporation. Notice the credit is to retained earnings because this is a net income situation for this year. If it were a net loss, this journal entry would be reversed. Corporations are organized from the top down. Stockholders are really the big bosses, but because they don't directly manage the corporation, they typically are not involved in any way, shape, or form in day-to-day policies and procedures, but they may be asked to opine on large issues that have to do with the future of the corporation. So if we took a look here at the structure of the corporation, the stockholders are the big bosses. They elect the board of directors, and the chairman of the board of directors gets elected by the board of directors themselves. They come up with the president and the chief executive officer, and then they have the following officers who serve under them. Under those officers are the people who tend to deal with the day-to-day operations. In a corporation, they have several items that make up their stockholders' equity. One of the major ones is those funds which came into the corporation by the corporation issuing stock. Issuance of stock is a piece of paper given to stockholders to show that they own part of the company, and in return, the corporation receives assets of some kind. One consideration when issuing stock is that there is such a thing as the par value of the stock. That sort of represents a minimum floor of protection for stockholders and creditors. It's a complicated explanation why, so that should be kind of good enough explanation for it. You don't need to go much more in depth. In addition to issuing the capital stock, if they issue it above the par value that has been set for it, then that will generate additional paid in capital, or also known as paid in capital in excess of par. That's the account it's typically captured within. Now, there are tricky figures with regard to stock. One of them is the number of shares. Number of shares have several factors. One of them is the number of shares that's authorized. When the corporation is organized, they go to the regulatory agencies for their state and other governing bodies and request to be able to issue X number of shares of stock at probably X dollars. This is the number of shares that's authorized. That's the number that they're legally capped, that they cannot issue more than without receiving approval for additional issuance. The number that they actually give out and receive something in return for is the number of shares issued. After the corporation has been organized, they can issue additional shares of stock for more funds, or they may, in some cases, issue shares of stock as kind of like a paper entry that does something that's of benefit to stockholders. Those would be stock dividends or stock splits. Now, the number of shares that's outstanding is the number of shares that's owned by outside parties. If the company buys its own stock back on the open market, that's called treasury stock. Treasury stock reduces the number of shares that are outstanding. So this is the trickiest number in this chapter. Number of shares outstanding gets used in several places, not the least of which is figuring out how much the company is going to pay in dividends, because they'll only pay dividends to outstanding shares of stock, not treasury stock. Now, there are some tricky figures with regard to values for stock. Market value is the price that the stock's currently selling at. If you were to Google the stock, you would get a stock quote for the day telling you the latest price at which that stock sold. Par or stated value is the legal minimum capital that I mentioned above. And book value is a computed number that you can find in the appendix to this chapter that tells you how you could calculate the value of a share of stock according to the company's books. It's not of much use to us in terms of what we're covering for this chapter. Another figure for value is one that would have to be computed by a specialist who deals with corporate asset valuations, and that would be called the breakup or the liquidation value. That would be the basically auction value of the assets of the company minus the liabilities. And so that could be substantially lower or could maybe substantially higher than the book value, depending on whether the assets have appreciated or depreciated over time. When you issue capital stock at par or no par, you debit cash for the number of shares you'd issued times the market price, current market price of the stock, and you credit capital stock, common or preferred, for the number of shares times their par. Now, because it's at par or it's also or possibly no par stock, these $2 amounts, even though they represent different things, the market price and the par, essentially because there is no par, you end up with the capital stock being credited for the same amount as the cash received. Remember, capital stock is a generic term for either common or preferred stock. If you issue the stock at above par, however, you'll issue the number of shares times their market price, and the debit would be to cash because we're receiving cash. You credit capital stock for the number of shares times their par, and because the market price is above par, there'll be a difference that will go into an account called paid-in capital in excess of par. Now, you may also issue your stock in exchange for property. In that case, what you do is you look to the most objective valuation you can find outside of the stock, such as the current fair market value of whatever assets you receive, and you credit capital stock for the number of shares issued times par, and credit paid in capital in excess of par if the fair market value is larger than the number of shares times par. Now, we have two major kinds of stock, common stock and preferred stock. Common stock, the stockholders have voting rights. They vote for elect the board of directors. They also have the potential for more price variability. So in theory, you'd like to be able to buy common stock at a low price and have it appreciate over time. And if you decide to get out from that company's stock, you sell it at a higher price than what you paid for it. That's the ideal, of course. However, common stockholders also have what's known as residual equity. That means they're last in line when it comes to distributions from the company if the company decides to liquidate itself or turn all of its assets into cash and pay off all of its creditors and pay off all of its stockholders. First, any proceeds after paying off creditors would go to preferred stockholders, and then if there is any remainder, that remainder would go to common stockholders. Sometimes that remainder is negative, and that means common stockholders receive nothing in the event of liquidation. Preferred stock, however, has no voting rights. Dividends are typically very, very reliable and dependable for preferred stock. You always receive your preferred dividends before common stock can receive any. That's what's known as a dividend preference. Also, in the event of liquidation, right after creditors are preferred stockholders. They also receive any distribution before common can get any. That's what's known as the liquidation preference. There are some special features of preferred stock. One feature is callability. If the company can force preferred stockholders to sell their stock back to the corporation for a certain price, then that stock is known as callable. Also, if the stock has a memory and remembers when it got missed dividend for a year of dividends, then it's called cumulative preferred stock. The dividends on the cumulative preferred stock have to be made up, and you have to pay for the current year's dividends before there's any chance of being able to give any dividends to common stockholders. Of course, if you never ever want to give any dividends to common stockholders, then you don't actually have to pay the preferred dividend. But if you ever decide to give any dividend to common stockholders, you have to make up for any years of missed dividends for the cumulative preferred stock. Participating preferred stock is a special kind of preferred stock that kind of gets to share in the party if there's super earnings for a year. And convertible preferred stock can be converted from preferred into common. There are some special types of convertible stock, typically common, I believe, that can be converted into debt or vice versa, typically debt to stock. Treasury stock, as mentioned above, is when the company buys its own shares of stock on the open market. This means we have shares that we now are holding and they're not outstanding, and so the number of shares outstanding has been reduced. Things you want to remember about this, easy misconceptions to not fall victim to. Treasury stock is not an asset. We haven't purchased an asset. We've reduced our stockholders' equity by giving away assets. Par doesn't matter to us when we're dealing with treasury stock because we're going to be using the cost method. And in addition, we're not undoing our issuance of stock. It's not a retirement of the stock. It's just a temporary holding of the stock that's not out there in circulation temporarily. So if you look at total stockholders' equity, you'll see paid in capital and retained earnings less the treasury stock, and the remainder then would be stockholders' equity. So this treasury stock sneaks in right before the total stockholders' equity and reduces it by however much the cost of that treasury stock was. Treasury stock transactions look like this. When you buy treasury stock, it's the simplest entry in the world. Number of shares you purchase times their cost. Debit to treasury stock, credit cash, number of shares you purchase times their cost. Notice treasury stock's a debit balance account. That makes it the opposite from all other stockholders' equity kinds of accounts, which are typically credit balance. When you sell the treasury stock is when things can get complicated. When you sell the treasury stock at its cost, you just undo the purchased. However, if you sell the treasury stock at above its cost, you'll debit cash for however much you sold it for, credit treasury stock for its cost, whatever it was you paid for it, and then the difference will go into paid in capital from treasury stock. Another stockholders' equity account goes under the subcategory of additional paid in capital. If, however, you sell the treasury stock at below its cost, you're going to debit cash for the number of shares you sold times their selling price. And because that's less than the cost, when you credit the number of shares times their cost to treasury stock, you'll need another additional debit amount in order to make your journal entry balance. So that essentially is a reduction of paid in capital from treasury stock. If you sell it so far below cost that you've wiped out all your paid in capital from treasury stock, it cannot go below zero. So the only alternative you have left is to take the remaining difference out of retained earnings. This is an unusual situation, but there may be some of this built into your exercises in Wiley Plus. Now, while all this is happening, there have been changes in the number of shares outstanding. You purchase the treasury stock, your number of shares outstanding drops. You sell your treasury stock, your number of shares outstanding goes up. So if we look at the situation for having any treasury stock whatsoever, your number of shares outstanding will be less than the number of shares issued. So outstanding and number of shares of treasury stock are inversely related. The more treasury stock you have, the less outstanding you have. A few more pieces of information here on retained earnings. Retained earnings is the amount of income that we've had minus any net losses and minus any dividends we've declared since the company was first incorporated. So it has a normal credit balance. Things that make it go up, net income, and if we have a special situation where we had to adjust for some error in a previous period, prior period adjustments. That would be in the case where our net income of a previous period may have been understated. Things that reduce retained earnings, net losses for a year, anytime we declare dividends, prior period adjustments where we'd previously overstated our income, and anytime we have this situation here where we sell the treasury stock at extreme amount below its cost. Cash dividends are a distribution of cash to our stockholders. They're based on our retained earnings. In other words, we're saying, here is your share of some of our earnings. So we reduce retained earnings whenever we declare dividends. Once the board of directors says they're going to pay dividends, it becomes legally binding. That's known as the date of declaration. So how do we compute it? If it's preferred, there's typically a dividend percentage. So 5%, $100 par preferred stock would pay $5 per share dividend. And if you have 1 million shares outstanding, your total preferred dividend would be $5 million. In the case of common stock, you have to be told how much the dividend per share is. It may be 25 cents per share, 10 cents per share, $1.50 per share, whatever you're given, you have to be told. And then times the number of shares, what? Outstanding, will give you your total common dividend. If you have a situation where they tell you the total dividends of all kind is X dollars, you have to first subtract the preferred dividend to figure out how much was given to common. And then if they further complicate it by asking you how much did each share receive, only the shares which are outstanding actually received a dividend. So you would not divide the total common dividend by number of shares issued. You'd have to divide it by the number of shares outstanding. So that's the situation here. Total dividends minus whatever given to preferred, the remainder must have been common. So if you make the journal entry for a cash dividend, on the declaration date, you debit cash dividends account for the total amount of dividends you're giving, like the amount computed up here, and you credit dividends payable for the total amount that you're giving. The record date occurs typically 2 to 3 weeks after this declaration date. But as a practical matter, what's known as the ex-dividend date is really the true date that really matters in terms of who gets the dividend. If the stock is sold prior to the ex-dividend date, then the purchaser of the stock will receive the dividend. However, if the stock is sold after the ex-dividend date, then the person who sold the stock will still get the dividend even though they no longer own it on the date of payment. When you pay the dividends, debit dividends payable to wipe out that liability, and credit cash, again for the total dividend amount. Always, again, based on the number of shares outstanding. Stock dividends, the most complicated thing in this chapter. Stock dividends have to do with giving out shares of stock instead of cash. Things that they do. Number one, they have no impact on your total stockholders' equity. They make your retained earnings go down, and they make your paid-in capital go up. So they affect elements of stockholders' equity, but not the total. Once they're distributed, the shares of stock are given out, not cash, shares of stock. That increases the number of shares issued and outstanding. And the stockholders don't get taxed on it because they're simply getting more shares representing their total investment in the company. When you make the journal entry for stock dividends, if it's a small stock dividend, which typically we're looking at, it can be called capitalization of retained earnings, or turning your retained earnings into paid-in capital. Retained earnings drop, paid-in capital going up. First, you have to figure out how many shares you're going to distribute. That's the percentage dividend, not a preferred percentage, but a 10% stock dividend means the number of shares we have of stock outstanding times 10% will be the number of shares we're going to distribute. Then you multiply that number, the number of shares to be distributed, by the dollar amount per share that you need to. The dollar amount per share that you need for the debit to stock dividends is the number of shares you're going to distribute times the current market value per share, the market value on the date of declaration. We'll call that the market price amount. The next amount you have to multiply the number of shares to be distributed by is the par value per share. Let's call that the par amount. And last, you have to make the journal entry to record the transfer from retained earnings to paid-in capital. And you do that by debiting the stock dividends account, which will get closed against retained earnings at the end of this period, crediting stock dividends distributable, which is a temporary stockholders' equity account, and permanently crediting paid-in capital in excess of par for the difference. When you distribute the shares, all you do is get rid of the stock dividends distributable, the par amount, by debiting it and crediting common stock. So you have then distributed your common stock dividend. So things you'll want to do are, number one, keep track of how many accounts or the balances of accounts that are impacted by your stock dividends and the number of shares of stock that you have issued as well as outstanding. Other additional things you can do besides stock dividend, you can do a stock split. A stock split involves giving out more shares of stock to our stockholders so that the effective market value of each of those shares of stock is smaller. If, for example, you wanted to make your stock in Google be more affordable, let's check here and see what's the current market price for Google. Right now, if I wanted to buy a share of Google stock, it would cost me $968.99. So suppose Google did a 4-for-1 stock split. So for each share of stock that stockholders currently held, they would receive 4. What would you expect to have happened to this market value? It should drop to 1/4 of its current amount. In reality, what typically occurs then, however, is that everybody's so excited about the fact that they had to split it that it's sort of like a success party, and the stock price tends to tweak up a little bit, even though it's supposed to go down to exactly 1/4 of its original cost. So a stock split then looks like this. The number of shares you used to have issued and outstanding has now doubled or tripled or quadrupled depending on its 2-for-1, 3-for-1, 4-for-1 stock split. 2-for-1 is traditionally the most common. Now, when you make the entry for a stock split, there's really nothing to debit or credit because it's just more shares issued and outstanding, and the par has to go down. So you multiply to get the new number of shares, both issued in Treasury as well as outstanding, and you divide to get the new par and the new cost per share of Treasury stock. In your books, you make what's known as a memo or memorandum entry. It's not no entry, it's just no debits and credits. There needs to be a record in your accounting system. It just doesn't involve debiting and crediting anything. So in that record, you'll want to list the new number of shares that are issued and in Treasury and outstanding, and you'll want to list the new par of the shares issued, the new cost per share for the Treasury stock. When we're last step here is looking at our company's stockholders' equity overall from an analytical standpoint. When you look at stockholders' equity, a big factor that many investors consider when considering whether to purchase company stock or not is what kind of return they can expect on their investment. And one of the factors that they would want to look at or measurements would be return on common stockholders' equity. It's what's known as a profitability ratio. It tells you the company's profitability from the viewpoint of common stockholders and tells you how many dollars of net income they can expect to earn for each dollar that they have invested in the company. So the higher the percentage, generally the better, because the company management has been more efficient at making a profit. And you can look at this year to year, like how we compare it to the previous year, and you can also compare it to other companies for shoulder-to-shoulder comparison about which company you might want to invest in. So you take your net income minus the preferred stock dividend requirement for the year, and that is the net income attributable to common shares. Divide that by your average common stockholders' equity, and you get return on common stockholders' equity. Thanks for listening. Hope this helps.